Hi, I'm Milena Tanzola. I welcome back Mickey Fulp from the Mercenary Geologist and Rod Husband from Cipher Research to complete our discussion on the real cost of mining gold. Mickey, we covered some ground. Can you please recap the discussion to this point?
The key points to be taken away so far is that the gold mining industry is plagued by non-standardized cost reporting, that OpEx, operating expenditures, and IMP, investment in mining properties, gobble up most of the annual revenues of the gold companies. And this has resulted in massive write-downs in a period of lower gold prices. And then we touched briefly on Cipher's new concept called the adequacy ratio to assess the profitability of gold mining companies. I think we should get into that in some more detail.
Rod, can you please tell us more about the adequacy ratio?
Absolutely. Our adequacy ratio is a simple measure of inflows over outflows. Inflows for mining companies are easy. That's the money that it gets from selling its product, in this case gold. The outflows that we use are the operating costs, G&A, investment in mining properties or IMP, debt repayments, and dividends. Now, it's a simple measure of the health of a company. Ratios above 1 means a company is healthy, it has the money to survive and grow. Ratios below 1, particularly for any length of time, means a company needs to go out and raise money either through debt or equity just to survive. To put it into context, over the last 5 years we looked at Apple. They have an adequacy ratio that's average 1.31. When we look at the 7 gold mining companies that we've evaluated, rarely has their ratios ever approached 1, never mind even close to 1.3.
I must admit, I find this quite surprising.
Well, it's really been eye-opening to me. Another way to look at this is a simple break-even analysis. And when we do that, we see that only in 1 year, 2011, when gold prices were at their all-time high, have the companies basically broken even. And the other 10 years during this bull market for gold, they have had deficits of anywhere from $200 to $500 per ounce of gold produced.
Yeah. Important note there as well is that the adequacy ratios here, the break-even analysis, don't include any cash for acquisitions that was used.
Clearly the industry is failing.
Well, in fact, it has a litany of failure over the last 11 years. For the most part, production levels have not grown and in some cases have declined significantly. We also see a growth of the resource and reserve base only through expensive acquisitions or incremental increases in gold price. These acquisitions have resulted in the companies taking on massive amounts of debt, and that debt has been written down over the last couple of years, write-down of assets during a period of lower gold prices.
So how are companies staying in business if they're continuously losing money?
Well, essentially the markets are supporting them through the purchase of debt and equity at inflated values. And this is evidenced by the price multiples given to gold mining companies. They're higher than a company like Apple.
Where's the premium coming from? If they're continuously losing money, it doesn't make sense.
Well, it would appear that the market is valuing their potential to grow. When we look at how the market values these companies based on reserves and resources, and important to note here, we use ounces of gold equivalent, we see that the market values these companies over the last 10 years at anywhere from $65 to $250 per ounce of gold in the ground, with the lowest values around $65 for Newmont and Barrick in the recent years. When we look at the cumulative average of all 7 companies for the last 10 years, we see the average price for an ounce of gold in the ground is $180. And that range is anywhere from $100, again, in the most recent year, up to $225 per ounce, which occurred twice in 2010 and again in 2005.
But Rod, Elena, your numbers have clearly shown that the gold mining companies have not grown production. They have only grown resources and reserves through massive acquisitions, which they've then written down, and they've not been profitable over the last decade.
Yes, the numbers show inefficiencies.
Absolutely. I mean, investors have basically been sold a line in order to provide the capital to perpetuate this myth. How crazy is it that companies raise debt and equity and turn around and pay dividends with it? The only way that this fundamental is going to change is through continued lack of or diminishing returns to shareholders.
In my opinion, the gold mining industry as a whole has to develop a new business model, and that would be a core philosophy of high margins. And so per ounce produced, so in times of high gold prices, the production would immediately grow, and in times of low gold prices, it would shrink. But no matter what paradigm we're given, what part of the commodity cycle we're in, the companies would continue to remain profitable with the idea of high value ounces. It's not about the quantity of ounces produced, it should be about the quality of ounces produced.
And this concludes our discussion on the real cost of mining gold. Let's summarize. We started with inadequate cost reporting.
Expenses have been capitalized and later written off.
Inflows have not been adequate to cover even the basic outflows.
In spite of robust rising gold prices, mining companies have managed to lose money.
Shareholders have not received adequate ROIs.
But our answer is simple. The focus should be on margin. In other words, the quality of ounces produced, not the quantity of ounces produced.
Gentlemen, thank you for sharing your thoughts. I look forward to another engaging discussion on our next topic. For more details and in-depth analysis on the real cost of mining gold, please visit Mickey at mercenarygeologist.com and Cipher at cipherresearch.com.